Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. A new type of mutual fund. Hopefully, investment strategy funds could become a useful alternative for well-off investors. Someone asked me what my opinion of this new type of mutual fund was, and I gave what I thought was the only possible reasonable response. Come back after 3 years and I'll tell you what I think of them. This is not a joke, not even a bit. I'm being a bit aggressive in my estimate. It will probably take 5 years to form a reasoned opinion of these funds. Anyhow, let's rewind a bit and see what is going on here. SEBI has announced the creation of a new type of mutual fund known as an investment strategy. While the name does not communicate much, it is essentially a higher risk and hopefully higher return variant of normal mutual funds. As the SEBI press release puts it, this new type of fund lies somewhere between existing mutual funds and portfolio management services, PMSs. Further, it tells us that this new type of fund is designed to offer greater flexibility and higher risk-taking capabilities for investors with deeper pockets. The minimum investment threshold is a substantial 10 lakh rupees per investor across all investment strategies within a particular AMC. This barrier is very high, roughly 1,000 times of most equity funds. Theoretically, it positions these funds as a product for more investors who can afford increased risk. On the other hand, it's just 1/5 of the 50 lakh rupees, which is the minimum for PMSs. One of the key motivations behind introducing this new category appears to be preemptive. SEBI aims to curtail the proliferation of unregistered and unauthorized investment schemes that often lure investors with unrealistic promises of high returns. The idea is that by providing a professionally managed and well-regulated product that satisfies that impulse within the existing mutual fund framework, investments that might otherwise flow into potentially risky, unregulated avenues can be channeled. It's important to note that while these investment strategies offer more flexibility in portfolio construction, they come with their own set of guardrails. SEBI has put in place several safeguards, including prohibitions on leverage, restrictions on investments in unlisted and unrated instruments, and limits on derivatives exposure. These measures mitigate risks and prevent the new product from entering too speculative territory. They also appear to be based on the excesses observed in the unregulated services and PMSs. However, looking beyond the bare announcement that has been made so far, the halfway house nature of this asset class means that it will be perceived by mutual fund investors and PMS investors or victims in contradictory ways. The message for the mutual fund investor is, here's a higher risk, higher returns type of mutual fund. If you are rich enough to afford the risk, go for it. For the PMS investor, the message is very different. Here's a better regulated, more tax efficient, more transparent, lower cost alternative to PMS. If you are tired of the empty, unverifiable promises of the PMS operators, then go for it. If you are a PMS investor, read the second description carefully. Properly designed, this new product should hollow out much of the PMS business. However, at this point, this product is just a few sentences in a SEBI press release. Everything else is just a possibility, not even a probability. To my mind, one red flag is that many AMCs themselves have a finger in the PMS pie, and it's hard to see them offering an alternative that will be worse for their businesses. That's why I said upfront that it will take at least 3 years to determine whether this will deliver much value. Many AMCs who are not deeply involved in PMSs will take up the challenge. Hopefully, the new asset class will offer a good choice for certain investors to deploy some of their money.